I will share my screen.
All right, we'll do that. Before we do, let me give a brief introduction of yourself, and then I'll pass it right over to you. As the head of rewards and channels at Brex, Thomas Piani is responsible for building the Brex Rewards program and establishing distribution partnerships for Brex. Previously, Thomas led projects teams at McKinsey & Company, management consulting firm, like one of the largest, I think, focusing on strategy in the financial services and payment space. And hey, Brex is a credit card, so this makes a lot of sense. He's a Stanford grad, and what does this say? École Polytech? Is that MBA in France?
Engineering school.
Okay, engineering school. Awesome. All right, Thomas, I'll let you take it away. Really excited for this presentation.
Awesome. Thanks, Derek. So I will share my screen. Great. Can you all see my screen?
Looks good. Perfect.
Awesome. Awesome. Well, thanks everyone for having me today. So I, as Derek said, I'm from Brex. We offer the first credit card specifically tailored for e-commerce companies. I'll talk a little bit about what Brex is, but most importantly, I want to talk about cash flow management and what does managing your cash flow mean when you're an e-commerce company, and how that relates to what Brex offers. So I think that's not going to come as a surprise for anyone who's here today, but cash flow management is really the lifeblood of e-commerce. That's how like online sellers live and die. It's really all about like managing your cash flow. And why is that, right? I mean, the most obvious answer is inventory to cash cycle. So when you're running an e-commerce business, you are obviously buying inventory. You're like spending on ads to fuel your growth. You're paying for shipping for all those sales, and you actually are only seeing the cash from the sales from your customer sales come through on your account month after those investments. So you need a way to invest in growth, invest to grow your business before you actually see the impact of that on your bottom line. And so that means you need to like manage your cash flow, right? You need a way to be able to spend before you have the money back. And especially when you're starting off, even when like up to like a good size of business, you still have that constant need that you need to be able to manage your cash flow to fuel growth. But not only that, but there's also something inherent to many e-commerce businesses, which is seasonality, right? And that also is part of the problem, because even though you may have kind of a pretty steady state business that's running well for most months in the year, come the holiday period, like your sales are going to be much higher then. So that means you need to invest in advance of that to have the inventory to fulfill those sales, invest in advertising, and all of that means you're investing more than what we're making the previous month. So same here, you need to be able to manage your cash flow. Now, when you're thinking about managing your cash flow, you could think, okay, I'm just going to go and like raise money, and that's how I'm going to do that, right? And in the like tech startup world, for instance, that's what companies do. They just go and they raise like venture funding, or they can raise debt, and that's the way that they manage cash flow. I think what we see is on the e-commerce side, right? Venture capital firms or investment professionals are often more reluctant to invest in e-commerce companies until they reach a really like large scale. And so it's really in that, like once you get venture funding and you're like a big brand, like great, everything's good for you. You don't really have those problems anymore. But in those initial stages, before you get to that point, that's really when cash flow management is really a meaningful problem. And same with like trying kind of traditional like debt financing. Like if you don't want to go with equity funding, but you're thinking, oh, maybe I can raise debt, like it takes a very long time, and typically online sellers or e-commerce companies are not kind of the primary target for those companies. So cash flow management matters, right? You need a way to manage cash flow, and thankfully there's a ton of ways that you can do that. There's a ton of solutions that are out there. Now, when you when you think about managing your cash flow as an e-commerce company, there's a few questions to ask yourself, like that help figure out what is the best way for you based on your business's need to do that, right? So the first question is like, how much cash do I need? Like, that's obvious, right? That's like, okay, how much do you think you need to invest in inventory? How much cash do you currently have? So how much do you need to bridge that gap? That matters a lot because depending on the answer to this question, you may go and choose a different type of solution, because some funding solutions have specific limits on what they can offer you. And so if you need $1 million, you're not going to go and get a cabbage loan that's like capped at like $250,000, for instance. So how much do you need? The next very important question is like, how long until you pay it back, right? Like, what's the bandwidth that you need? And that really matters because that's going to impact one, what is the solution that you want to use, and what are the payment terms that you think are like suitable for you, right? Like how long do you have until you have to pay back the loan? And then 3, that's also going to impact like ultimately like how much you pay for it, or like how you think about how much it's going to be for you. Number 3 is how expensive is this going to be, right? So that's we just talked about how long this is, how long until you need to pay it back. Like, how expensive is obviously like the third super important question. Like, what are the fees? And there, I think that's something that's super important to think about is, different solutions, and we'll talk a little bit about that later on, but different solutions talk about fees in different ways, right? So for some it's like APR, for others it's like a fixed fee and a repayment period, but there's always fees involved very often, and it's really important to think about that because it can get quickly very expensive. The last part of this that really matters is really like, how flexible do you want this to be, right? What are the other, and that's something that also sometimes can be overlooked. But when you think about the solution that you want to go with, you want to look at things like, are there like prepayment penalties if I take out a loan and then I need to pay it back, in 2 months? If I pay it early, like, is that fine? Like, do I just pay like less interest, or are there like prepayment penalties? Or are there like other terms that are like hidden in there that you need to be wary of? So that's kind of the assessing solutions, right? Like, how much do you need? What are the limits? How long until you can pay back? What are the payment terms? How expensive are you going to be? Like, how much is it going to cost? What are the fees? And then like, what are like other terms? Like, how flexible do you need this to be? So then, what's the landscape, right? Like, when now you've gotten good answers to those questions, and you have a good sense of what is it that actually makes sense for you. What's the landscape of things like I would say traditional short-term funding solutions that you can think of that exist in the market? Well, obviously you have like bank loans, right? That everyone knows about. You can do those for pretty much anything. The problem is those take a long time. You gotta go like in person in a bank. There's often high interest. You pretty much always have to have personal guarantee. You can also do an inventory loan, which is like a version of a loan where you're basically pledging your inventory to get a credit limit. That also takes a long time because it requires the lender to actually verify your inventory. Like the third thing that exists, then there's kind of like those new age like sellers that you all know about that often have funding solutions or loan solutions. So like Amazon has theirs, Shopify has theirs, PayPal has theirs. So those, they're good, right? They fund very quickly. They give you a limit based on your sales on the platform, and so that's really positive. The limit of these is that often, basically, they only take into account the sales from that particular platform, right? So if you're getting like a Shopify capital loan, it's based on your sales on Shopify. And if you're, often e-commerce companies are relying on multiple platforms, right? So you're kind of like not getting the benefit of having of your full sales in terms of getting like the maximum limit that you could get, because it only takes into account your sales that you're doing on Shopify, for instance. And the other big limitation of these is that they're often very expensive. And they're very expensive because it's, either they have like just very high stated APRs, or they present options as like fixed fee that you're paying with a very short repayment period. And when you actually do the math, you realize that, APRs are like as high as like 20% or 30%. Or even like higher in some cases. And that's a lot, right? That's like a very expensive way to fund your business. It gets hard to make this work, especially if you're kind of running a business with lower margins, if you have to pay those types of interests. And then there's other kind of non-traditional lenders like Cabbage. Cabbage, they're like a good option for small businesses in general. A big problem is they also have very high interest rates. And the other limitation is that the loan amounts are often limited too. So that's what an example, like some of the like kind of most popular examples that exist in the market today. I guess kind of in summary, what are the benefits of those solutions? I mean, they're flexible, right? In the sense that once you get a loan, you basically just get cash in your bank account, and then you can do whatever you want with it, right? So like you can use it for inventory, you can use it for ad spend, you can use it for like any other expense for your business. So that's in that sense, that's like really flexible. It's not like you're just getting a loan specifically for your inventory. The other benefit is, at least for the kind of new like tech forward solution, it's fast to fund, right? Like the application process is pretty quick. They have your sales, so they can validate your sales like pretty quickly, and then you get the funds like quickly in your account. The major downsides, right, that are very, very often the case in pretty much all of the solutions are, number one, they're personally guaranteed, or like you need to like give like a collateral amount. So personally guaranteed, like that really matters, right? That means basically that if the loan goes unpaid, you are personally liable as an individual for that loan, even though this is a loan that you took for your company, right? Like the reason why companies incorporate is to separate liability between individual and the entity. And so this is like a pretty, obviously like a pretty big negative point. The other limitation that we talked about a little bit already is that those solutions are often limited to platform-specific sales, and sometimes have like clear caps on the amounts that they're able to lend. And that's obviously also a big limitation, especially if you're a seller that is using multiple platforms. You want to have your full sales be considered in when you're getting a credit limit, because that's really what your business is versus just the sales on like a particular platform. And then the last thing is, they're very expensive, right? And especially I would say the faster, the more tech forward solution, the faster to fund. Often they're very expensive, and it's not always transparent like how much this is actually going to cost you. But that really often is a big part of the potential issues. So good. So we kind of went through those different options. They have like very good positives, but they also have some drawbacks that we talked about. And I guess the question is like, are there other alternatives other than those basically loans, right? Like, or funding options. So then the thing we didn't talk about yet is credit cards, right? credit cards are, I mean, also a way, at least from an individual perspective, a way that you can get credit, right? Which is what we're talking about here. The problem is, frankly, in general, like when you think about traditional credit cards, your Chase, your Amex, your Capital One, or any other sort of like small business credit cards, they're really not ideal for cash flow management. And why are they not ideal? Because they have personal guarantees and they have low limits in general. So all traditional small business credit cards, whether you're going to American Express or Chase or Bank of America or Capital One or really any of those traditional providers, they are personally guaranteed, right? So you're getting a business credit card or a small business credit card, but the application is actually based on your personal credit history, right? You are giving your personal credit score. The limit you get is based on your personal credit history, and the card is personally underwritten to you as an individual, meaning, again, that if for some reason the balance goes unpaid, that gets reported to your personal credit score, that then is that gets reported to your personal credit file, and that impacts like your personal credit score, that impacts your ability to get a mortgage, that has a lot of other consequences. And same with the limits, right? The problem with those cards is that because they're personally underwritten, they actually give you limits based on your personal credit history, right? Like they would give you personal credit card limits. So you can get a card with maybe like $20,000 spend limit if you have, or $30,000 if you have like a good personal credit history, but that often doesn't really match what you actually need for your business. The other big drawback is similar to some of those short-term funding solutions. They have like very high interest fees. They have high APRs, right? So annual percentage rate, which is what cards charge as soon as you carry a balance past the statement period. And it's typically those, basically you get like your statement period, which is like 30 days. And then as soon as you carry a balance, even for 1 day past the 30 days, you get charged with interest fees. And the way that card companies charge those fees is really by actually, like they kind of trick you a little bit, right? Because it's as soon as even if you carry a balance from 1 more day than the statement period, you actually get charged on your average balance for the full statement period. Meaning, even though you just carried your balance for 1 day, you actually get charged as if you had carried a balance for a full month, which is kind of unfair, but that's how like traditional card companies do this. And then the last, I guess, part of this is that's obvious but those cards are not tailored to e-commerce in any sort of way, right? Like the cards that you can get access to, at least when you think about like a Shopify Capital loan or like an Amazon loan, like those are made for e-commerce companies, and so they have limits based on percentage of sales, and they're kind of made for this demographic. That's not the case for credit cards, right? Like credit cards traditionally, you go to American Express and you say, hey, I'm an e-commerce company, I want a credit card. They'll tell you, yeah, choose from one of our small business credit cards, which are not made for online sellers. They're made for like small businesses in general, like your florist shop, your restaurant, your professional services firm, and your e-commerce companies. And so that matters because that means that some of the perks and the benefits that those cards offer don't really jive with what you care about as an e-commerce, right? Like the where you get points if you get points, where you get like additional perks or discounts, like that often is not necessarily relevant for e-commerce. So cards are not a great option for cash flow management in general, but it's kind of unfortunate, right? Because if you think about a credit card, it would be nice to be able to use your card as a way to fund your business, because that's a lot more convenient than having to first get a loan and then use that loan to pay for expenses, right? You can just do everything at once. What if you had a card that allows you to finance your business? Like you can put charges on the card and then you can pay them off only later, and use that as a way to manage cash flow. And that's kind of what the approach that Brex took, right? So just like a little bit about Brex. So Brex, we're a fintech company a credit card company. So we provide credit cards for small businesses. We're a MasterCard branded credit card, so accepted like anywhere that MasterCard is accepted all over the world. And we built a card specifically tailored for e-commerce. And because we realized that there was this gap in the market, and that kind of traditional credit cards were not a good fit. So what's different about Brex? Brex is a card where you get net 60-day payment terms with 0 interest. So what that means, net 60-day, is that any transaction that you put on the card, you get a full 60-day to pay that transaction. So if you put a transaction on the card today, you have to pay it off in the next 60 days. If you put another transaction on the card tomorrow, you have to pay that one in 60 days from the moment of that transactions. And that's different from kind of traditional credit card statements, right? Because if you have a traditional statement, it basically closes at the end of the month every time, meaning that if you do a transaction like 2 days before the end of the month, that transaction is going to be in the statement that closes just 2 days later. So our card offers a full 60-day for any transaction, all of that with no interest, right? 0% interest. So you can literally get a full 60 days to pay any transaction, and you're paying no fees. The other really good thing about Brex is that we have no personal guarantee. And the reason we have no personal guarantee is that we underwrite the business, not the individual. So we don't require a personal credit score. We don't look at personal credit history at all in our underwriting. We look at your business's sales, and that's the major information that we use to underwrite you. So the cards are not personally guaranteed, meaning that if your business goes down and there's a balance on the card and you can't pay it, then we're not going to come after you as an individual. Like it's not tied to you individually, and it also doesn't go on your personal credit report. The card also has like very high limits compared to traditional cards. And the way we do limits is we base them on historical sales across all platforms. So what we do is we look at your bank account data. We have integration with your e-commerce platforms as well. So we use transaction data that we see in your bank account. We look at your Shopify sales, your Amazon sales, your BigCommerce sales, your Magento sales, like any platform that you're on, we can look at those sales. And we give you a credit limit that's based on those historical sales across all those platforms. So on average, you get a limit that's between 50 and 100% of your historical monthly sales. So if on average you're selling 100K a month across all platforms, that's what you're going to get as a monthly credit limit. So that's meaningful limit that you can then go and reinvest for your business. On top of that, we built a ton of like expense management and tech functionalities that come with the card. So you can create virtual cards and physical cards. You can create cards for different users and have different limits for different users. You can integrate with accounting software that you use, like QuickBooks, Xero, NetSuite, Expensify. You can capture receipts and upload them, like all of that kind of functionality that also helps with just like closing your books. And then lastly, we also have rewards that are relevant for e-commerce providers. So on the I would say cashback side, if instead of like paying in 60 days, you actually want to pay in 30 days, then you get like 1% back. So you kind of get a bonus if you decide that you want to pay early. We offer full 60 days, but if you're paying early, you get that bonus. And then in addition to that, we've negotiated discounts with a number of e-commerce providers that you basically, by signing up for Brex, you immediately get access to all of those deals. And so those are companies like Shippo or Signify, like Piani, Amazon Web Services that gives you like $5,000 worth of credit, Zoom for like phone that we're using right now, like all of those things. So you get about like $50,000 worth of value from like 20 or 25 partners that we have available. So that's kind of what we built. So a card that allows you to actually manage your cash flow. And by the way, the reason why we can do that is that the way we make money, right? It's not like there's any sort of like hidden fees or anything like that. the way we make money is we make money on transaction revenues. So the way credit card transactions work is every time that you're paying at a merchant, that merchant is actually getting on average only $97 for every $100 that you pay. And there's about like $3 or 3% fee that's charged by MasterCard to that merchant. And then we, as the bank of the issuer of the card, get a portion of that. And so that's how we make money. So because we make money in that way, we don't need to charge interest on the card or charge fees on the card. A little bit more about like Brex and some of our customers. So our e-commerce customers, some of the most famous ones you can see here on this slide. We have a wide range of customers. The kind of two key requirements that we have to be able to underwrite customers is having kind of an average of more than $50,000 or more of e-commerce sales monthly. So that means it can be lower in some months, but like on average, it kind of has to be around $50,000 or higher. And then the other requirement is that you have to have been in business for a year or more. Now that's something that we can be like a little bit flexible on. If you have meaningful sales, but you've only been around for like 8 months, like we'll still be able to underwrite you, or we'll look at this favorably. But in general, we require to have been in existence for at least 12 months. So that kind of concludes this presentation. We have a dedicated link if you want to sign up, where we offer through our partnership with Derek and eCommerce Tech, waive card fees for life. So typically we charge an annual fee for the card for like each card that you generate, but we actually waive that completely forever for any customer that we get through our partnership with eCommerce Tech. So there's that link. I think Derek will also share it later. And if you have any questions, because I know I went through this very quickly, you can email ecommercetech@brex.com, and that goes to me and to other members of my team, and we'll be happy to answer any question that you have. Thanks for your time. And now I'll pass it back to Derek.
Thank you very much, Thomas. I have one question for you. This is that I've been meaning to ask for a while. Do I have to have a US-based like business, a EIN in one of the states or something like that?
Yeah, no, great question. I didn't mention that, so thank you for mentioning this. Yes, so you do. Today we hopefully that will change in the near future, but today we need a US EIN. So you need to be incorporated in the US. It doesn't mean that your business has to be like headquartered in the US. Like we have, doesn't matter, but you have to have at least an entity that's incorporated in the US.
Gotcha. Probably for the underwriting component of it. That's
exactly
awesome. Finally, a credit card for e-commerce stores that doesn't suck. The only reason not to get a Brex card, in my opinion, is if you've got hundreds of thousands of dollars in the bank.
Right.
And that's kind of a stretch for a lot of e-stores, I would say, because we're always pushing that cash flow to the max, reinvesting as fast as we can. Awesome. Thank you again, Thomas.